It's fascinating how in finance, you often encounter different theories or models all aiming to explain the same fundamental truth: what drives stock returns, why some companies perform better than others.
Hmm.
But then you start to wonder, are they truly offering unique insights? Or are they just different lenses looking at the
Yeah.
same puzzle, perhaps with varying degrees of clarity?
Right.
Today, we're going on a deep dive into precisely this question, specifically within the complex yet incredibly important world of financial factor models.
Yes.
These are the sophisticated frameworks that investors, researchers, portfolio managers use to dissect and understand the forces that move stock prices.
That's right. And over the past few years, we've seen a veritable explosion in these models. I mean, really, a lot of them.
Yeah.
Each one comes with its own distinctive set of factors, characteristics of companies or market trends that are supposedly predictive of future stock returns. It can feel like a new factor acronym is born every other week, making it incredibly challenging, to discern what truly matters.
Definitely feels that way sometimes.
And as our source material powerfully reveals, these seemingly disparate models are often surprisingly interconnected, and crucially, they are not all built on equally robust theoretical foundations. That last point is key.
Our mission today is crystal clear. We want to cut through that noise. We're going to systematically unpack these prominent new generation factor models, put them through rigorous head-to-head empirical tests, and most importantly, scrutinize their underlying economic foundations. We want to get to the absolute core of which factors truly matter and why they matter.
The why is critical.
Exactly. So that by the end of this deep dive, you'll walk away well-informed, equipped with a clearer understanding, and certainly without drowning in all the technical jargon.
Hopefully.
We're drawing our insights from a truly compelling and comprehensive paper titled Which Factors?, penned by Koei Hum, Haitao Mo, Chen Xu, and Lu Zhang, published in the prestigious Review of Finance in 2019, along with its extensive supplementary appendix.
A really thorough piece of work.
Okay, let's unpack this. For those who might be less familiar or just need a quick refresher, what exactly are factor models in finance?
Right.
And why have they become so central to our understanding of stock returns? What problem are they actually trying to solve?
That's a great place to start. At their heart, factor models are simplified yet powerful representations of inherently complex market behavior.
Okay.
Think of them like a highly sophisticated radar system, maybe, that helps us identify the major forces influencing stock prices.
Right, like picking out the signal from the noise.
Exactly. Their main purpose is to capture systematic risks. These are broad, undeniable market risks that affect a wide range of assets. And you can't simply diversify them away just by holding lots of different stocks.
Got it.
It's these systematic risks that fundamentally drive expected returns, or at least that's the theory.
Okay.
They give us a framework to understand why certain types of stocks, for example, those from smaller companies, or what we traditionally call value stocks, tend to perform differently on average over long periods.
Historically, finance started with simpler models, like the single-factor capital asset pricing model, CAPM.
Yeah, the classic beta is everything.
Right. Beta is your only measure of risk. But as researchers observed persistent patterns in stock returns, that CAPM simply couldn't explain what we called anomalies.
Like the size effect, the value effect.
Exactly those.
Right.
The field evolved, leading to the development of these multi-factor models. Each new factor was an attempt to capture an additional dimension of systematic risk, or perhaps even, systematic mispricing that CAPM had overlooked.
And this paper we're dissecting today zeroes in on what you've called a new generation of these models. Given this evolution, why the sudden explosion, this proliferation of new models, and what's the paper's overarching goal in taking them on?
Yeah, the financial literature has indeed been flooded with new models in recent years. Honestly, it feels like that sometimes.
It does, each one proposing its own unique set of factors to explain the cross-section of expected stock returns. It can feel like every other academic paper is introducing a new alphabet soup of acronyms and factors.
Yeah. RMW, CMA, RAA, RED.
Exactly. This paper by Hu, Mo, Yu, and Zhang is incredibly important precisely because it cuts through that noise. Its core mission is to bring some order to this sprawling landscape.
Okay.
It aims to empirically compare these recently proposed, seemingly diverse factor models, and crucially, to evaluate their conceptual soundness.
Right. Not just if they work, but how and why.
Precisely. It's not just about which one looks good on paper based on past data. It's about rigorously testing if they actually offer unique insights, or if many are simply different ways of measuring the same underlying economic phenomena.
The redundancy issue.
Yes, the authors are seeking to identify redundancies where multiple factors are essentially saying the same thing, highlight genuinely unique contributions, and perhaps most critically, assess the strength and validity of their underlying economic theories.
That theoretical part feels really key.
It is. Are these factors merely statistical patterns we've discovered in historical data, or do they have a deep, logical, and robust economic reason for existing? That distinction is paramount.
So, before we literally put these models into the ring for a head-to-head comparison, let's take a moment to introduce our main contenders.
Good idea.
The key factor models this paper scrutinizes. Think of it as meeting the gladiators before the contest begins.
Excellent analogy. First up, we have the Zhang models themselves, often referred to as the Q factor and Q5 models.
Okay, the author's own models.
Yes, introduced by Hu, Zhu, and Zhang in 2015, with the Q5 model augmenting the original in 2018. What truly sets these models apart, and we'll definitely dig into this later,
Right, you mentioned the theory.
is their exceptionally robust theoretical foundation. They are directly derived from a fundamental theory of corporate finance called the Investment Capital Asset Pricing Model, or investment CAPM.
Investment CAPM.
Okay. This means they're not just statistical constructs. Their factors emerge directly from economic first principles about how firms invest and operate.
That sounds promising. What are the factors?
The original Q factor model includes 4. The standard market factor, capturing overall market risk, a size factor, which they call RME, representing small versus big firms, an investment to assets factor, RIA.
RI/A.
Yes, RIA. It measures the tendency for firms investing less aggressively to outperform those investing more aggressively.
Interesting. Less investment equals higher returns.
On average, yes, according to this factor. And then there's a return on equity factor, ROE, reflecting that more profitable firms tend to generate higher returns.
Okay, profitability makes sense.
The Q5 model then adds a 5th factor to this set, an expected growth factor, Reg.
REG.
Right, REG.
Yeah.
This targets firms with higher projected future asset growth.
Investment CAPM. That sounds pretty foundational indeed. It's intriguing that these factors are explicitly tied back to a fundamental economic theory right from the start. We'll definitely deep dive into that economic underpinning later, as it truly seems to be a key differentiator when we compare it to other models.
Absolutely, it is. And that theoretical grounding is central to understanding their sustained empirical performance, as the paper argues.
Okay. Who's next?
Next, we have the French models, the FF models, arguably the most widely recognized and frequently cited factor models in all of finance.
Yeah, the household names, if you will.
They really are the benchmark against which many new models are judged. The French 5-factor model, introduced in 2015, built upon their earlier seminal 3-factor model,
Which was market, size, SMB, and value.
HML. Exactly. The 5-factor added 2 new factors: robust minus weak operating profitability, known as RMW.
MW profitability.
Right. And conservative minus aggressive investment, or CMA.
CMA investment. So similar themes to the Q factors, it seems. Profitability and investment.
Very similar themes, yes. The idea behind R&W is that more profitable companies should generate higher returns. CMA posits that companies investing more conservatively outperform those investing aggressively. Their even newer 6-factor model from 2018 further enhances this by adding a momentum factor, UMD.
Momentum UMD. Past winners keep winning.
Right. And it also introduced an alternative cash-based profitability factor, RMWC, as a potentially more robust measure.
RMWCE. Okay, so multiple versions of FAMA French.
Yes, they've evolved over time.
And these FAMA French models are pretty well known, often seen as the gold standard for comparison, right? So any model challenging them faces a significant hurdle.
Precisely. They are the established heavyweights, but the paper doesn't stop there.
Who else in the ring?
It also examines a few other notable models. There's the Stambal Yuan, or SY 4-factor model from 2017.
SY. Yeah.
This model takes a somewhat different approach. It groups 11 well-documented market anomalies.
11.
Wow. Yeah, into 2 composite mispricing measures. MGMT, which aggregates anomalies related to management decisions like net stock issues, asset growth, things like that.
MGMT management decisions.
Yeah, and PERF, which captures performance-related anomalies like momentum and gross profitability.
PERF.
Yeah.
Performance. So they bundle anomalies together.
Exactly. Stamba and Yuan argue these composites capture systematic mispricing rather than just risk.
Interesting distinction.
Then we have the Daniel Hirschleifer Son, or DHS, three-factor model from 2018.
DHS, 3 factors.
Their model is distinct for attempting to motivate its factors from behavioral finance.
Ah, psychology enters the picture.
Right. Looking at how investor psychology might lead to predictable patterns. It includes a financing factor, FIN, based on measures of corporate financing activities.
FIN, finance.
And a post-earnings announcement drift factor, PE.
Oh, PED, that earnings drift phenomenon.
Exactly. Capturing the tendency for stock prices to keep drifting after an earnings surprise.
Okay, so behavioral roots there.
That's the claim. And finally, the Barillas-Shankin, or BS, six-factor model, also from 2018.
BS 6 factors. What's special here?
This one's quite unique because it's essentially a hybrid. A best-of compilation, maybe?
Like a supergroup.
Ah, something like that. It strategically combines the market factor, Froment-French's SMB, the Q factors, investment, and row factors.
Oh, so it borrows from the Q model.
Yes, explicitly. Alongside the Asnis-Farzini monthly formed HML called HMLM, a powerful value factor.
HMLM, monthly value.
And the momentum factor, UMD. It's an attempt to synthesize the best elements from various successful models into one.
Wow, that's a lot of acronyms and factors to keep straight. It's like a full roster of financial all-stars, each with their own unique style.
It really is.
And so given this crowded arena, what's the most effective, most rigorous way to compare them empirically? How do we determine who truly shines?
That's the million-dollar question, isn't it? How do we move beyond just listing these models and actually figure out which one is genuinely superior?
Yeah, how do we judge the contest?
The paper primarily tackles this using a technique called spanning tests.
Spanning tests, okay.
Now imagine you have two distinct toolboxes, Model A and Model B. Each toolbox contains a set of specialized tools, or factors, designed to explain stock returns.
Got it.
A spanning test basically asks, can all the unique jobs that Model B's tools are designed to do also be accomplished using only Model A's tools?
Ah, can Model A do everything Model B does?
Essentially, yes. Specifically, we take the return premiums generated by the factors of one model, let's say Model B, and then we regress those premiums against the factors of another model, Model A.
Okay, run a regression.
Right. If Model B's factors still exhibit statistically significant alphas, which are essentially unexplained returns, even after accounting for Model A's factors, then it clearly signals that Model B possesses unique predictive power that Model A lacks. Model A can't completely span or explain Model B.
So the alpha tells you if there's something left over.
Exactly. Conversely, if those alphas become economically small and statistically insignificant, it means Model A largely subsumes or completely explains Model B's factors. It's a rigorous test of whether one model truly adds unique information over another.
Okay, so to simplify, if Model A can absorb and effectively neutralize the unique return premiums of Model B's factors, but Model B can't do the same for Model A, then Model A demonstrates a more comprehensive explanatory power. Is that the essence of it?
You've got it, exactly. That's the essence of the test. Now let's dive into the results, starting with the big guns. The Q factors against the Froment-French models.
All right, the benchmark battle, hashtag 3.1, the Q factor and Q5 models versus the Froment-French 5 and 6 factor models.
Okay, the first and arguably most significant finding from the paper is this. The Froment-French models consistently cannot explain the Q and Q5 factor premiums.
Cannot explain them, okay.
When the Q and Q5 factor returns specifically their investment factor, RIA, return on equity factor, RRO, and that expected growth factor, red. When those were tested against both the Froment-French 5-factor and 6-factor models, they stubbornly showed statistically significant alphas.
So Froment-French leaves something on the table.
A lot, actually. This is a powerful finding, indicating that the FF models simply could not fully account for the unique return premiums embedded in these Q factors.
Can you give an example?
Sure. Take the Q factor's investment factor, RIA. It generated an impressive average return of 0.41% per month.
Okay.
And that had a robust t-value of 4.92, so statistically reliable. Now, Froment-French has their own investment factor, CMA, right?
Right, CMA.
Yeah.
Conservative minus aggressive.
Yes. But despite having CMA in their 5-factor model, a significant chunk of RIA's premium 0.11% per month remains stubbornly unexplained. It had an alpha with a t-value of 3.44.
Still significant then?
Very. And the six-factor model yielded a very similar alpha, 0.11% with a t-value of 3.11.
So even with a similar sounding factor like CMA already present, the Fama-French model couldn't fully capture the essence of the Q-factor's investment signal. That's pretty telling.
It absolutely is. Suggests something fundamentally different is being measured or measured better.
Right.
And here's where it gets really interesting regarding the profitability factors. The Q-factor's row premium, R row, averaged a strong 0.55% per month, t-value 5.25.
Okay, solid return.
The F at 5-factor model reduced this only slightly, leaving an alpha of 0.47% with a t-value of 5.94. Still huge.
Barely touched it. Why?
This striking result highlights a critical methodological difference. The Q-factor's row factor is constructed from monthly sorts using the latest quarterly earnings data.
Fresh data.
Very fresh.
Yeah.
In contrast, Fama-French's R&W, their profitability factor, relies on more stale annual operating profitability data.
Annual versus quarterly. That makes a difference.
A big difference, it seems. This difference in data timeliness proved crucial, making the Q-factor's row factor significantly more powerful in capturing profitability signals right when they emerge.
Makes sense. What about the Q5 factor, Red?
The expected growth factor, REG, from the Q5 model, that averaged a substantial 0.82% per month, with an incredibly high t-value of 9.81. Massive.
Wow.
And this factor was largely unexplained by both Fama-French models. The 5-factor model left an alpha of 0.78%, T11.34.
Still almost the whole premium.
Exactly. And the 6-factor model left 0.7%, T11.1. Essentially untouched.
Okay, so individual factors survive. What about testing them all together?
Good question. That's where the Gibbons, Ross, and Shanken test, the GRS test, comes in.
Right, the joint test.
It assesses whether all alphas from a group of factors are simultaneously zero, and the GRS test strongly rejected the Fama-French model's ability to explain the Q and Q5 factors.
Strong average.
Overwhelmingly. For example, testing just the investment and row factors together, the GRS statistic was a massive 22.72 against the FF 5-factor model. The p-value is effectively zero.
Zero p-value means no chance it happened by luck.
Pretty much. It's a resounding, statistically overwhelming rejection. It tells us the Fama-French model simply cannot explain these Q-factor premiums jointly.
And with the expected growth factor included.
It got even worse for Fama-French. The GRS statistics skyrocketed to 55.14, again with a p-value of 0.00. It's like the model isn't just falling short, it's completely out of its depth explaining these Q factors.
That's a powerful statement about the Q factor's unique explanatory power. Now, what about the reverse? This is the key test, right?
Yes, the other side of the coin. Can the Q factor models explain away the Fama-French factors?
Let's hear it.
Here are the results flip. The Q factor and Q5 models largely subsume the Fama-French factor premium.
Largely subsume. Okay.
When Fama-French factors were tested against the Q factor and Q5 models, their alphas were, for the most part, economically small and statistically insignificant.
So the Q models neutralize the FF factors.
Mostly, yes. A strong indicator of the Q model's superior explanatory power. Let's look at specifics.
Okay.
SMB, Fama-French's size factor, earned 0.25% per month, T1.93. When regressed against the Q-factor model, its alpha shrank to a mere 0.04%, T1.42.
Pretty small. Insignificant.
Borderline may be slightly statistically insignificant, depending on your threshold. Against the Q5 model, it was 0.07%, TD2.29. Maybe weakly significant, but economically tiny.
Why does it shrink?
Because the Q-factor's own size factor, RME, which captures a very similar size effect, largely explained it. They're highly correlated.
Okay, makes sense. Now, the big one for many people, HML value.
Right. Here's where it gets really interesting. HML, the famous Fama-French value factor, averaged 0.37% per month, T2.71.
A classic anomaly premium.
Yes. But when pitted against the Q-factor model, its alpha was a tiny 0.07%, T0.62.
Wow, almost gone.
Almost gone, and an even smaller 0.05%, T equals 0.48 with the Q5 model, both statistically insignificant.
That's a true mic drop moment for HML. What explains it?
This suggests that the Q-factor's investment factor, RIA, is doing much of the heavy lifting that HML traditionally captured.
So investment explains value.
Largely, yes. It indicates a deep, shared economic driver. In fact, RIA had very large factor loadings on HML, around 1, and they were highly significant, with T values above 11. They moved together strongly.
Fascinating. What about CMA, FF's own investment factor.
CMA earned 0.33% per month, T3.51. Its Q-factor alpha was virtually zero, minus 0.00%, T.02.
Completely gone.
Completely, almost entirely explained by the Q-factor's investment factor, RIA, which showed a massive loading of 0.96, T33.56. Makes sense, they are both investment factors, but RIA seems to capture it more cleanly, perhaps.
Okay. And RMWFS profitability.
RMW earned 0.26%, TP2.5. Its Q-factor alpha was a minuscule 0.01%, T4.8. Insignificant.
Also gone. Explained by.
Largely explained by a substantial loading on the Q-factor's rho factor, RRho, of 0.54, T-CLIA.5.
Okay.
Again, the Q-factor equivalent seems dominant.
Even momentum. UMB?
Even UMD, which generated 0.65% per month, T0.61. The Q-factor model significantly reduced its alpha to 0.12%, TP0.9. The Q5 alpha for UMD was weakly negative, -0.16%, TQ0.78, with both the rho and expected growth factors contributing significantly.
So the Q factors together explain momentum.
Yes, and this hints at a compelling economic intuition. Momentum winners are often, in fact, more profitable and expected to grow faster. Their characteristics align perfectly with the Q-factor explanations.
That makes sense. Any FF factors survive the Q models.
There was one notable exception, RMWC, Fama French's cash-based profitability factor.
Ah, the alternative profitability measure.
Right. It earned 0.33%, T-Wolf 4.16, and did survive the basic Q-factor model with a significant alpha of 0.25%, T-Cool 3.83.
Okay, so RMWC has some unique information.
It seems so beyond the original 4 Q factors. However, the Q5 model, by adding the expected growth factor reg, managed to reduce this alpha further to 0.14%, T2.18.
So Q5 weakens it, but maybe not completely kills it.
Right. It's borderline significant, suggesting expected growth explains part of RMWC, but maybe not all. Still, Q5 does a better job than Q factor.
And the GRS tests, the joint tests again.
Once again, the GRS test solidified the Q factor model's dominance for the crucial null hypothesis that the alphas of HML, CMA, RMW, and UMD were jointly zero.
Testing if Q models explain these 4 FF factors together.
Exactly. The GRS statistic was only 0.36, p-value 0.84 in the Q-factor model, and 0.65, p-value 0.62 in the Q5 model.
High p-values, what does that mean?
It means we failed to reject the null hypothesis. We cannot say the alphas are significantly different from zero. In other words, the Q-factor models could jointly explain these key FF factors.
Wow. That's strong evidence.
Very strong. Only when RMWC was included did the basic Q-factor model show a rejection, GRS 6.14, Pickle 0.0.00.
As expected, since RMWC survived individually.
Right, but then the Q5 model largely subsumed even that, bringing the GRS statistic down to 1.81 with a p-value of 0.13.
So Q5 handles the FF bundle, even with RMWC included.
Largely, yes. The p-value of 0.13 means we can't reject the null that all alphas, including RMWCs, are jointly zero in the Q5 model.
So what does this all mean for the Fama French models, particularly in light of these powerful Q-factor results?
Well, it strongly suggests the Q-factor models offer more comprehensive explanation.
It seems the Q-factor models, especially with their timely data for the rho factor, offer a much more comprehensive and, frankly, superior explanation of stock returns, effectively absorbing most of what Fama French brings to the table.
That's certainly what these spanning tests indicate, yes. The Q factors seem to encompass the information in the main FF factors, while the reverse isn't true. Tag 3.2, the Q factor and Q5 models versus the Stambaugh Yuan SY model.
Okay, moving on from Fama French. What about the Stambaugh Yuan model, the one that bundles anomalies?
Right, the SY model. And here you've hit on a critical point that extends beyond just the Fama French comparison. Factor construction really matter.
The details of how you build the factor.
Exactly. The devil is often in the details. Stambaugh Yuan actually deviated from several traditional factor construction methods, and these subtle choices can significantly impact a model's perceived performance.
How so? What did they do differently?
For instance, they used 20th and 80th percentiles for breakpoints when forming their portfolios, rather than the more commonly accepted 30th and 70th percentiles.
Okay, different cutoffs.
They also used the entire universe of NYSE, Amex, and NASDAQ stocks for breakpoints, instead of just NYSE stocks, which is standard practice to avoid potential biases from tiny microcap stocks dominating the extremes.
Right. NYSE breakpoints are common.
And rather uniquely, they defined their size factor to include only middle portfolios, not the smallest or largest, which is a departure from how most size factors are built.
So Even slight methodological choices in how you build these factors can have a massive impact on a model's results and how we interpret them. That's a crucial detail.
Precisely. It's a key takeaway. The paper emphasizes the absolute importance of comparing apples with apples.
Fair comparison.
So they meticulously replicated the SY factors using the traditional methodological approach, standard breakpoints, NYSE sorts, etc., to ensure a fair and consistent comparison.
And did it make a difference?
Yes. Their findings clearly show that the SY model's performance is surprisingly sensitive to these seemingly minor construction choices.
Interesting. Okay, so how did SY fare against the Q factors in the spanning tests?
Well, the Stanbaugh-Ewan model cannot explain the Q and Q5 factors.
Same story as Fama French, then?
Pretty much, yes. Stanbaugh-Ewan's original model, using their unique construction, could explain the Q factor's size and investment factors, interestingly.
Okay, so I got those two.
But it notably failed to explain the rho factor. It left a significant alpha of 0.33% per month, TK 3.55 for our rho.
So it couldn't capture profitability.
Right. And more strikingly, it also couldn't explain the expected growth factor, reg, leaving a large alpha of 0.55%, T9.04.
Okay. What about the replicated SY factors using standard methods?
The results with the replicated SY factors were largely consistent, still leaving significant alphas for the rho factor, 0.32%, T4.71, and the expected growth factor, 0.58%, T10.25, still couldn't explain them.
And the GRS tests?
Predictably, the GRS tests again delivered a strong rejection. Both the original and replicated SY models couldn't jointly explain the Q and Q5 factors. For instance, the GRS statistic for just investment in rho factors was 8.16 P0.00 in the original SY model, and 12.12 P is 0.00 up in the replicated model. Clear rejection.
Okay, SY can't explain Q. Can Q explain SY?
Here again, the tables turn. The Q5 model does subsume the SY factors, especially the replicated ones.
Q5 comes out on top again. How?
The original MGMT factor, the management anomaly composite, averaged 0.61% per month, T4.72. The basic Q factor model left a significant alpha, 0.36%, T4.73.
So Q factor alone wasn't enough.
Not quite for the original MGMT, but the Q5 alpha was dramatically reduced to beyond 0.12%, T1.64, which is borderline insignificant.
Expected growth helped explain MGMT.
Yes. Now, for the replicated MGMT factor using standard methods, which averaged 0.47%, T4.68, the Q factor model yielded a still significant alpha of 0.2%, T3.59.
Still surviving Q factor.
Yes, showcasing Q5's strong explanatory power for the replicated, arguably more comparable MGMT factor.
What about PRF, the performance factor?
The replicated PRF factor, averaged 0.49%, T3.67, saw its Q factor and Q5 alphas become statistically insignificant right away. 0.03% T worked 289 to 0.18% T worked 1.87 respectively.
So Q models handled PRF easily.
Yes, and the GRS tests further confirmed that the Q5 model effectively subsumes both the original and replicated Stanbaugh-Ewan factors. For example, the GRS statistic for jointly zero alphas of the replicated MGMT and PR factors in the Q5 model was 2.38 with the p-value of 0.09.
P0.09. So cannot reject the null.
Cannot reject, meaning the Q5 model appears to explain the replicated SY factors jointly.
What's fascinating here is that the replicated Stanbaugh-Human factors actually turn out to be very close to the Q factors. You mentioned high correlations.
Yes, correlations of 0.8 between replicated PRF and RO and 0.84 between replicated MGMT and RIA. Very high.
So in a way, their empirical cluster analysis essentially rediscovered the Q factors, which, as you keep pointing out, are themselves motivated from the deep theoretical grounding of the investment CAPM.
It's a very insightful way to put it.
It's almost as if the data, when properly analyzed using standard methods, independently leads back to the same fundamental economic drivers represented by the Q factors.
It certainly looks that way based on these results. The SY factors, when constructed traditionally, look very much like proxies for investment and profitability, just like the Q factors. Hashtag 3.3, the Q factor and Q5 models versus the Daniel Hirschleifer-Son DHS model.
Okay, next contender. The Daniel Hirschleifer-Son model, the DHS model. The one with behavioral motivations.
That's the one. And again, we encounter issues, or at least differences, with factor construction methods diverging from traditional norms.
Déjà vu. What's different here?
Well, for example, their financing factor, FIN, uses what the paper describes as an ad hoc procedure for combining various financing measures. It lacks a clear, consistent theoretical underpinning for how those measures are combined.
Sort of arbitrary weighting?
Potentially, yes.
Maybe.
Similarly, their PEED factor, the post-earnings announcement drift factor, only utilizes one of three common PEED measures, whereas much of the literature suggests combining them for a more robust signal.
Okay, so just like with Stand By You On, these seemingly minor choices in how factors are built can significantly alter their apparent performance and potentially their validity.
Precisely. It's a recurring theme. And again, replicating their factors using traditional methods like creating more standard composite scores for SEFI and PEED and using the standard 30/70 NYSE breakpoints demonstrates that the DHS model's performance is indeed sensitive to these construction choices.
Consistency in method matters. Okay, results. Can DHS explain the Q factors?
No. The DHS model cannot explain the Q and Q5 factors.
What are the key failures?
A significant limitation right off the bat.
Right.
The DHS model, notably, does not include a size factor.
No size factor at all.
No. Consequently, it naturally couldn't explain the Q factor size premium RME. The alphas were large and significant, 0.46%, T3.11 for reproduced, 0.63%, T4.25 for replicated.
Makes sense. If you don't have a size factor, you can't explain size.
Right. Beyond that, it also failed to explain the investment factor, RIA. Alphas were 0.18%, T at 2.56 for reproduced, and 0.32%, T4.34 for replicated.
Still significant.
And it failed to explain the expected growth factor. Reg alphas there were 0.56%, T7.42 for reproduced, and 0.54%, TCM.45 for replicated. Huge alphas.
So it fails on size, investment, and expected growth. What about rho?
Interestingly, the DHS model did manage to largely subsume the rho premium, R rho. The alphas were statistically insignificant. 0.1% T.83 for reproduced and 0.14% T1.91 for replicated factors.
So it could explain profitability. How?
Likely through its PEED factor, which is related to earnings news and less profitability, but even though it explained rho,
You failed on the others.
right. And the GRS test still robustly rejected the DHS model's ability to explain the key Q and Q5 factors jointly. It just couldn't handle the full set.
Okay, DHS fails to explain Q, the other way around.
Here it's a mixed bag. The Q and Q5 models can explain DHS's affine factor, but not its PEED factor.
Okay, break that down. Affine first.
The reproduced affine factor, the financing factor, had a premium of 10.83%, T.55. The basic Q factor model left a significant alpha, 0.33%, T2.67.
Not fully explained by Q factor.
But the Q5 alpha was insignificant, 0.14%, T-Wills 1.12. So expected growth helped explain FIM.
Okay, what about the replicated affine?
Crucially, the replicated FIN factor premium using standard methods was more than halved. It yielded only 0.32%, T2.53.
Wow, factor construction mattered a lot there.
Hugely. And for this replicated affine factor, both its Q factor and Q5 alphas were very close to zero and insignificant.
So the Q models did explain the replicated FI factor.
Yes, particularly highlighting the strong explanatory power of the Q factor's investment factor, RIA. The replicated affine factor showed a notable correlation of 0.69 with the Q factor's investment component, suggesting again they're tapping into similar economic drivers related to investment and financing decisions.
Okay, so FIN is explained, but you said not PEED.
Correct. Here's the interesting twist. Neither the Q nor Q5 models could fully explain the pedo factor.
The earnings drift anomaly persists.
It seems so, at least relative to these models. The reproduced P factor averaged 0.62%, T7.73. It still showed a significant Q factor alpha of F.56%, T5.66, and a Q5 alpha of 0.47%, T5.32.
Still large alphas.
Yes. Similarly, the replicated PEED factor, averaging 0.72%, T7.78, also showed significant alphas against Q factor, 0.43%, T5.13, and Q5, 0.31%, T4.07.
So we're seeing a consistent pattern emerging. The Q factors, particularly the investment factor, appear to capture much of what these other mispricing or financing factors are getting at. But this PEED factor from DHS seems to be a remarkably persistent anomaly, even for the powerful Q models. It suggests PEED might be capturing something truly distinct.
That's a very astute observation. It points towards potentially different mechanisms, maybe more behavioral, as DHS suggested, or perhaps related to information processing delays that aren't fully captured by the investment and profitability dimensions of the Q models. It's a remaining puzzle. Hashtag 3.4, the Q factor and Q5 models versus the Barilla-Shanken BS model.
Okay, last head-to-head. The Barilla-Shanken model, the BS model. the hybrid kitchen sink model.
Exactly. This model is quite unique, as we mentioned, because it explicitly incorporates the Q factor's own investment and row factors.
So it includes RIA and RO.
Yes, alongside other very common factors. Market, Fama French's SMB, Momentum UMD, and the monthly formed HMLM, from Asnes Frazzini.
Right, HML.
The idea here is maybe if you throw all the successful factors together, you get the ultimate explanation.
The everything bagel of factor models.
Perhaps. But even this comprehensive approach had limitations. The BS model cannot fully explain the Q5 expected growth factor.
Even with all those factors, it missed reg.
Yes. Despite its diverse array of factors, including the Q factors RIA and RO, the BS model still couldn't fully account for the expected growth factor, reg, from the Q5 model.
How big was the alpha?
It left a substantial and highly significant alpha of 0.6% per month with a robust t-value of 8.78.
Still huge.
Very much so. This powerfully suggests that reg provides unique, distinct information about expected returns that is simply not captured by that extensive list of factors within the BS model. Expected growth truly stands out.
Okay, so reg is unique. What about the factors in the BS model? Did Q and Q5 explain them? For instance, HMLM, the monthly value factor.
Now this is an interesting point. We see QQ5 struggle with HML initially, but a monthly formed Q factor performs better.
Okay, explain that. HMLM first.
The monthly formed HML factor, HMLM, which is in the BS model, earned an average premium of monthly 4% per month, T2.13.
Yep.
Neither the original Q factor nor the Q5 model could fully explain this premium. They left significant alphas of 0.37%, T2.36 for Q factor, and 0.41%, T appear 2.99 for Q5.
So HMLM survived the standard Q models. That seems like a point against Q.
It might initially seem that way, but if we connect this to the bigger picture and look at the factor loadings, it appears that while the Q factor's investment factor, RIA, had large positive loadings on HMLM, for example, 0.93, with a t-value of 8.18, meaning they moved together.
Okay.
Its impact was largely offset by equally large but negative row factor loadings. Our row loaded a negative 0.69, T fixed 6.78 on HMLM.
So investment and profitability worked in opposite directions for HMLM.
Exactly. These two strong Q factors were essentially pulling in opposite directions regarding HMLM, effectively canceling out some of the explanatory power.
Interesting interaction. But you said a monthly Q factor did better.
Yes. But here's the crucial caveat. When the Q factors themselves were reconstructed using monthly sorts on all three characteristic size, investment to assets, and row matching the monthly frequency of HMLM.
Ah, apples to apples frequency.
Precisely. This monthly formed Q factor model did a much better job. It yielded insignificant alphas for HMLM. 0.18%, T-0.97.
Wow, so matching the sorting frequency was key.
It powerfully reinforces our earlier point. The choice of data frequency and timeliness in factor construction is not just a technicality. It can profoundly impact a model's ability to explain observed premiums, especially when comparing factors built with different frequencies. Hashtag 3.5, the factor family tree correlation matrix.
Okay, that's been a lot of individual battles and specific numerical results. We've seen some fascinating individual matchups, with the Q factors consistently coming out strong, especially Q5. But if we pull back from the individual skirmishes, is there a bigger picture? Do these factors, despite their different origins and constructions, actually speak the same language?
That's a great question, and the paper addresses it directly.
That's what the paper reveals when it maps out their family tree using a correlation matrix, right? It's like a DNA test for these factors.
That's a perfect way to put it. And what's truly fascinating here, once you step back and look at the correlation matrix provided in the paper, is how many of these seemingly different factors are, in fact, highly correlated with one another.
So they're related.
Very related. This strong correlation suggests they are capturing very similar underlying risk or mispricing dimensions, despite their different labels and sometimes different construction methods. It vividly highlights significant redundancies across these numerous models.
Can you give some examples of these family ties?
Absolutely. Let's break down some of the key relationships. First, size factors. The Q factor, size factor, RME, and Fama French's SMB are almost identical twins.
How correlated?
Extremely high correlation of 0.97. This tells us they are essentially measuring the exact same thing. The small minus big size effect. No real difference there.
Okay, size is size. What about investment and value?
Here it gets interesting. Investment and value factors. The Q factor's investment factor, RIA, shows consistently high correlations with a whole host of other factors.
Like which ones?
It correlates strongly with Fama French's HML, the traditional value factor, at 0.67.
RIA and HML correlated. That explains why RIA subsumed HML.
Exactly. It also correlates with Fama French's own investment factor, CMA, at a remarkable 0.91.
Wow, 0.91. Basically the same factor again.
Pretty much, and it correlates highly with the replicated MGMT factor from Stambaugh Yuan at 0.84.
The management anomaly composite.
And with the replicated FIN factor from Daniel Hirschleifer's son at 0.69.
The financing factor.
Right. This cluster of high correlations powerfully suggests that HML, CMA, MGMT, and FIN are all, in essence, capturing very similar investment-related pricing information. They are different proxies for a shared economic phenomenon related to how firms invest, or perhaps mispricing related to investment.
A big investment value family. What about profitability?
A similar story. Profitability and performance factors. The Q factor's rho factor, R rho, also shows strong family ties.
Who's in this family?
It's highly correlated with Fama French's RMW profitability at 0.67 and with RMWC cash-based profitability at 0.57.
Okay, correlates with FF profitability.
It also shows a notable correlation with UMD, Fama French's momentum factor, at 0.50.
Profitability and momentum linked.
Yes, suggesting that momentum often contains a strong underlying profitability signal, which aligns with our earlier finding about RO helping explain UMD.
Right.
More importantly, RO has exceptionally high correlations of 0.80 with the replicated P or F factor from Stambaugh Yuan,
The performance anomaly composite.
and 0.69 with the replicated PV'd factor from Daniel Hirschleifer's son.
Even PE'd. I thought that survived.
The replicated PV'd factor correlates strongly with RO, 0.69. This indicates a broad family of factors linked to firm profitability and past stock performance. High profitability and good past performance, including earnings surprises, often go hand in hand. The PE'd factor premium itself survived the Q models, but the factor construction is clearly related to profitability.
Ah, subtle distinction. Okay. Any links for expected growth, Reg?
Yes, expected growth linkages. The expected growth factor reg in the Q5 model, while having unique power as we saw, also shows notable correlations. It correlates with RMWC 0.59, RRO 0.52, RIA 0.38.
So it's linked to profitability and investment.
Yes, and also the replicated MGMT factor, 0.54, and the replicated FIN factor, 0.54.
Linked to those anomaly composites too.
Right. This suggests that firms with high expected growth often exhibit certain characteristics related to their current profitability, their investment strategies, and even how they manage financing or past performance signals. It ties into multiple dimensions.
So if these factors are so highly correlated, it really calls into question the need for so many distinct models. It almost feels like we've been trying to solve the same puzzle with slightly different redundant pieces.
That's a great way to put it.
Especially if some of those pieces have stronger theoretical grounding than others, right?
Precisely. The correlation matrix is one of the most compelling pieces of evidence from this paper because it starkly highlights this redundancy. It strongly points towards a common, more fundamental set of underlying economic drivers that these myriad different factors are all attempting to proxy for, sometimes imperfectly.
So we don't need 10 different ways to measure investment.
Probably not. It reinforces the powerful idea that many of these factors, despite varied origins and constructions, are essentially proxies for similar phenomena. This insight makes a unified, theoretically grounded model, like the Q-factor model, incredibly valuable.
Why valuable?
Because it can potentially explain much of the market's behavior with a more parsimonious, coherent, and economically intuitive set of factors. It truly simplifies our understanding without sacrificing explanatory power. It suggests focusing on the core economic drivers, investment and profitability, might be the most fruitful approach.
We've seen the empirical battle unfold, and the Q-factor and Q5 models have consistently demonstrated powerful explanatory capabilities, often subsuming their competitors.
Yeah.
That seems pretty clear from the data.
The empirical evidence is quite strong, yes.
But you mentioned something earlier, and several times since, about first principles and robust economic foundations. Let's dive deeply into that now, because it's not just about what works empirically. It's profoundly about why it works, right?
Absolutely.
Without a strong why, an empirical finding can sometimes just be a fluke or data mining or something that won't persist out of sample.
That's absolutely spot on. The why is paramount for a model's long-term reliability and interpretability. And this is where the Q-factor models really shine, according to the authors. A unique, And indeed, a highly significant advantage of the Q factor and Q5 models is their exceptionally robust economic foundation.
Okay, remind us what that is again.
They are derived directly from the investment capital asset pricing model, or investment CAPM.
Right.
This is not just an academic nicety. It means their factors investment, RAA, ROW, and expected growth, REG, aren't merely statistical constructs discovered by, crunching mountains of historical data until a pattern emerges.
Not just data mining.
Exactly. Instead, they arise directly and logically from a fundamental economic theory of how firms make real investment decisions.
Okay, can you give us the intuition for the investment CAPM again, simply?
Sure. The theory basically posits that companies invest in new projects and capital.
Mm.
They keep investing until the marginal cost of that investment equals the marginal Q.
Marginal Q, what's that?
Marginal Q is essentially the market value of an additional unit of capital in that firm. Think of it as what the market thinks an extra dollar of assets is worth to that specific company.
Okay, so firms invest until cost equals market value of the investment.
Roughly, yes. In simpler terms, firms invest more when their market value for new capital is high, indicating profitable growth opportunities are perceived by the market. This theory, therefore, directly links a firm's investment decisions and its profitability decisions, which are observable accounting variables.
Like investment to assets and return on equity.
Precisely those. It links them directly to its expected stock returns. It provides a clear, coherent, and intuitive economic rationale for why these specific accounting variables should systematically predict returns. It's a complete framework explaining both firm behavior, investment decisions, and asset pricing, expected returns, simultaneously.
So rather than just identifying correlations or patterns in past data, these Q factors are actually rooted in the very fabric of how businesses fundamentally operate, grow, and allocate capital.
That's the argument.
That makes them inherently more intuitive, more reliable, and arguably more stable over time because they are tied to real foundational economic activity rather than just statistical happenstance.
Precisely. That's the core power claimed for this approach. In sharp contrast, the paper points out that many competing models,
Like who?
including the Stambo-Yuan, Daniel Hirschleifer's son, and even the Fama-French six-factor model, are acknowledged by their own creators, or certainly critiqued by this paper, as being largely statistical in nature, ad hoc, or empirical, without deep economic justification.
So FF is statistical. I thought they had a theory.
They do attempt a theoretical motivation, which we'll get to next, but the argument here is that relative to the investment CAPM's first principles derivation, those other models, including FF, are less directly tied to fundamental theory. While they might capture certain empirical patterns, they often lack the coherent first principles-based narrative that the investment CAPM provides for the Q factors.
That distinction feels profoundly important if you're trying to build lasting understanding.
It is, especially if you're betting on a model for the long run, beyond the specific data sample it was tested on. Hashtag 4.2, deconstructing Fama-French's valuation theory motivation.
Okay, now you just alluded to it, but Fama and French, 2015, did make a significant effort to provide an economic foundation for their five-factor model. They didn't just pull RMW and CMA out of thin air.
That's correct. They explicitly based it on the residual income valuation model.
So they did try to build a Y.
Yes, definitely. This wasn't just a statistical exercise for them. However, this paper by Hu et al. Raises some pretty serious and detailed concerns about that theoretical motivation. Finding it inconsistent or problematic in several key areas. This seems like a critical vulnerability for what many consider to be the benchmark model.
Let's hear the critiques. This sounds important.
It's an absolutely crucial line of inquiry in the paper. It asks, does their valuation theory truly support their factors, RMW and CMA, as originally advertised? The paper systematically and meticulously critiques 4 key assumptions or implications of the Fama-French 2015 reasoning, revealing what they argue are significant conceptual cracks in their theoretical edifice.
4 critiques. Okay, what's the first one?
Let's start with critique 1. The internal rate of return, IRR, is not equal to the 1 period ahead expected return.
IRR versus short-term return.
Right. Fama and French made an implicit assumption, or at least strongly implied, that a stock's short horizon expected return, say over 1 month, is positively and closely related to its long-term internal rate of return, IRR, derived from their valuation model.
They treated them as similar.
They often treat these as if they are interchangeable or perfectly aligned proxies for the discount rate. However, the Who in All paper argues convincingly that this assumption is deeply problematic because it fundamentally contradicts the well-established notion of time-varying expected returns. Short-term expected returns can fluctuate significantly, maybe due to risk aversion changes or market conditions, independently from a stock's long-term fundamental IRR, which is more tied to long-run cash flows.
Okay, theory says they can differ. Does the data agree?
The empirical evidence presented in the paper is truly striking here. The IRR, estimated using their framework, can differ drastically from the one period ahead expected return observed in the market.
Drastically? Like how?
For example, take Fama French's RMW factor, the profitability factor. When IRRs were meticulously estimated using analysts' long-term earnings forecasts from 1979 to 2016, following the logic of the FF valuation model, the average IRR implied for the RMW factor was a significantly negative -1.58% per annum. The t-value was negative 9.66.
Negative IRR for high profitability firms relative to low. That sounds backward.
It does sound counterintuitive based on the factor's positive premium, but that's what the model estimation implied. Yet the actual one period ahead average return of that RMW factor over the same period was a significantly positive 4.52% per annum, with a t-value of 2.88.
Wait a minute. So their own model's long-term projection for the RMW factor, using analysts' forecasts, suggests a negative average long-term return difference, but the actual observed short-term average return of that very same factor is strongly positive.
Exactly.
That's a massive disconnect. That's an aha moment for sure, and it completely undermines the assumption that these two concepts, IRR from the model and short-term expected return, are interchangeable or even closely related.
Precisely. It's a fundamental contradiction highlighted by the paper, and this large, statistically significant difference was not an isolated incident.
It happened elsewhere.
It was observed consistently in many of the 12 different estimation experiments the authors conducted, using different ways to estimate expected ROE and different accounting models, particularly for RMW and to a lesser extent for CMA. This discrepancy severely weakens the Fama French motivation, which attempts to link these factors directly to a stock's IRR via their valuation theory. The empirical reality just doesn't align with that specific theoretical premise.
Wow. Okay, that's critique number one. What's number two?
Moving on to critique two. HML redundancy contradicts valuation theory, supports investment CAPM.
HML being redundant. We saw that empirically when RMW and CMA were added.
Exactly. Fama and French's own empirical finding that their HML value factor becomes redundant in describing average returns once RMW and CMA are added to their three-factor model is another critical point.
Why is that a critique of their theory?
Because from the perspective of their valuation theory, this empirical redundancy of HML is actually a puzzle. Their theory, based on the valuation equation relating price to book value, expected earnings, and expected growth, suggests that market to book, the characteristic from which HML is derived, should give rise to a separate, distinct factor. It's a key term in the valuation equation. Yet, empirically, it becomes redundant once RMW and CMA are in the model.
So their theory predicts HML should matter independently, but their data says it doesn't once RMW, CMA are there.
Correct. However, if we connect this to the bigger picture, this empirical redundancy of HML actually aligns perfectly with the investment CAPM.
How so?
The investment CAPM explicitly posits a tight economic linkage between investment, which drives CMA and the Q factors RIA, and value, market to book, which drives HML. High investment firms tend to be growth firms with low book-to-market. Low investment firms tend to be value firms with high book-to-market based on that theory.
So investment and value are two sides of the same coin in investment CAPM.
Very much so. And our earlier observation from the correlation matrix that HML has a high correlation with CMA, 0.69, and with the Q factors RIA, 0.67, empirically supports this theoretical linkage.
Right. The correlations backed it up.
Thus, CMA, as an investment factor, can be viewed as an effective substitute for the value effect via the market-to-book term in the valuation equation. What's an anomaly for Fama French's theory, HML becoming redundant, is a natural outcome predicted by the investment CAPM.
Fascinating. A weakness for one theory is a strength for the other. Okay, critique three.
Critique three. The relation between expected investment and expected return is positive, not negative.
This sounds counterintuitive, maybe? Expected investment and expected return. positive?
Well, Fama and French 2015 argued that their valuation equation 2 in their paper predicted a negative relation between expected investment and the IRR. This negative relation was their theoretical basis for the CMA factor, low investment firms having higher returns.
Okay, that was their argument.
However, the Hu, Mo, Zhu, Zhang paper demonstrates that when that very same valuation equation is rigorously reformulated in terms of the one period ahead expected return, which is arguably the more relevant return concept for asset pricing tests.
Right, the return we actually observe over short periods.
Yes. Specifically, looking at equations 4 and 5 in the Hu et al. Paper, which reformulate the valuation using one period expected returns, it actually implies a positive relation between expected investment and the one period ahead expected return.
Positive.
How? It's a bit technical, but it's because a key term in the reformulated equation representing the expected profitability of new investments relative to book equity, specifically PIT plus 1 B8 plus 1 1, is likely positive in real-world data for most firms. This flips the sign of the relationship compared to Fama French's interpretation based on IRR.
So their own theoretical foundation, when re-examined with what this paper argues are the correct definitions for expected return and proper mathematical formulation, actually points to the opposite conclusion from what Fama and French originally claimed.
That is precisely the argument made in the paper.
And even more strikingly, it points to a conclusion positive relation between expected investment and expected return that's completely consistent with the Q factor's investment, CAPM motivation for the expected growth factor, REG. High expected growth investment firms should have high expected returns.
Exactly. It aligns perfectly with the Q5 model's reg factor, where high expected investment predicts high returns. It flips the FF theory on its head and makes it consistent with the Q model intuition instead. A truly profound theoretical reevaluation.
Mind blown a little bit there. Okay, critique number 4.
And then there's critique 4. Past investment is a poor proxy for expected investment. This addresses a critical flaw, not in the theory itself, perhaps, but in Fama and French's operationalization of their theory.
How they build the CMA factor.
Yes. They use past investment, recent asset growth, as a proxy for expected future investment to construct their CMA factor. The theory talks about expected investment, but the factor uses past investment.
Is that a bad proxy?
This paper argues it's deeply problematic, citing a vast body of economic literature on what's known as lumpy investment.
Lumpy investment?
Yes. Research from prominent economists like Dixit and Pindyke, Doms and Dunn, Whited, consistently emphasizes the profound lack of persistence of micro-level, firm-specific investment data.
Meaning what?
Meaning, what a firm invested last year often tells you very little about what it will invest next year. Investment decisions are often discrete, lumpy big projects happen infrequently, and they're highly contingent on specific opportunities appearing. It's not smooth or easily predictable based on the recent past.
So using last year's investment to predict next year's is shaky ground.
Very shaky, according to this literature. This fundamentally questions the very foundation of using past investment to forecast future investment, which is what CMA is implicitly trying to do based on the theory about expected investment.
Does the paper show evidence for this lack of persistence?
Yes, compelling empirical evidence. They run annual cross-sectional regressions showing that current asset growth or current book equity growth are remarkably poor predictors of future book equity growth, especially beyond 1 year.
How poor?
The predictive power, measured by slope coefficients and R-squared values, drops off rapidly. It often plummets to near zero within just a few years.
Give me numbers.
Okay, for instance, the average R-squared when predicting future book equity growth using current asset growth falls from a modest 5% at the 1-year horizon.
Only 5% predictability, even 1 year out.
Yes, only 5%. And it falls to effectively 0% by year 4, and it remains at 0 for subsequent years. This holds even for larger, more established firms. Assets, $5, book equity, $2.05. There's almost no predictive power in past investment for future investment beyond the very short term.
This is a huge insight. It suggests that relying on past investment to predict future investment, the basis for CMA as motivated by theory, is fundamentally flawed.
That's the strong conclusion drawn here.
But you're telling me that this doesn't apply to all past accounting measures. What about profitability, RMW?
That's the critical distinction. In stark contrast, the paper shows that past operating profitability is a remarkably good predictor of future operating profitability.
How good?
Its average R-squared starts at an impressive 54%, predicting 1 year ahead.
54%, all as 5% for investment. Massive difference.
Huge difference. And profitability's predictability decays much more slowly. It only drops to a still strong 27% predicting 3 years ahead and remains above 10% even predicting 10 years out.
So profitability is persistent, investment is not.
Exactly. This highlights the crucial difference. While using past profitability to proxy for future profitability, as in RMW, seems reasonable and empirically supported, using past investment to proxy for future investment, as in CMA, seems questionable, both theoretically due to lumpy investment literature and empirically due to lack of persistence.
That's a significant blow to the theoretical underpinnings of Fama French's CMA factor, at least as it was originally presented and motivated by expected investment.
It certainly challenges that specific motivation quite directly. Hashtag 4.3 statistical versus theoretical models. So if we connect all this back to the broader landscape, the consistent empirical success of the Q factor and Q5 models in the spanning tests, combined with what the authors argue is their unequivocally robust theoretical foundation derived directly from the investment CPM.
Right, the first principles approach.
Gives them a significant and arguably unparalleled advantage in this specific comparison.
Over the other models tested.
Yes. The paper powerfully concludes that many of the other models, while they might capture some empirical patterns or anomalies, are ultimately more ad hoc or less firmly rooted in economic first principles.
Even DHS with its behavioral story.
Right. For instance, even the Daniel Hirschleifer and Son 2018 model, which attempts to motivate its factors from behavioral biases, is critiqued in this paper, citing other literature too, as lacking a clean one-to-one mapping or a strong, rigorous conceptual linkage between the specific behavioral theories and the precise factor constructions they use.
So the link between behavior and factor is maybe weak.
Or at least not as tightly derived as the Q factors are from investment CAPM. Their factors are acknowledged, sometimes even by their proponents, to be more statistical or empirical in nature. The distinction is fundamental. One set of models, the 2 factors, provides a coherent why derived from economic theory for its what, the factors. The others often rely more heavily on empirical observation without the same level of deep, internally consistent first principles theoretical backing.
It sounds like this deep dive really separates the wheat from the chaff, showing us that a strong, internally consistent theoretical backbone isn't just an academic luxury. It often translates directly into more robust, more coherent empirical results.
That seems to be the case here.
And critically, it leads to a much better understanding of which factors truly drive returns and why we should trust them over time. It simplifies our understanding without oversimplifying the market's complexity.
Well said. A good theory provides structure and interpretation that pure empiricism often lacks. Hashtag tagged out.
Wow, what an incredible, truly comprehensive deep dive into the intricate and, let's be honest, often confusing world of financial factor models.
It can definitely get confusing.
It's become abundantly clear, though, that not all factors are created equal. And understanding their theoretical roots, their foundational why, can truly make a profound difference in how we perceive, analyze, and even try to predict market movements.
Absolutely. I think this paper delivers a powerful message on several fronts. First, many seemingly disparate factors are, in fact, closely related, highlighting significant redundancies. We don't need dozens of factors measuring the same thing.
Right, the correlation analysis showed that clearly.
More importantly, it demonstrates that the Q factor and Q5 models, which are deeply grounded in the rigorous investment CAPM, provide a remarkably powerful and theoretically coherent framework.
Empirically strong and theoretically grounded.
Yes. This framework not only largely subsumes many of its competitors empirically, as we saw in the spanning tests, but it also offers crucial, almost surgical insights into why other models, like Fama French, might fall short on their own theoretical claims. It really provides a unified lens.
So what does this all mean for you, our learner? It means that when you're looking at different financial models, or maybe evaluating investment strategies that rely on certain factors, asking what's the strong, coherent economic theory behind this is just as important, if not more important, than just asking, does it work empirically based on past data?
Couldn't agree more.
An empirical pattern without a solid theoretical foundation can be fleeting. It might just be luck or data mining. A strong, intuitive economic foundation helps us trust a model's long-term relevance and its ability to perform beyond just the historical data it was discovered in.
That's a profound takeaway. The distinction between factors that emerge organically from a rigorous economic theory versus those that are purely statistical or ad hoc is absolutely critical for long-term understanding and practical application. Factors derived from first principles, like investment and profitability in the Q model framework, offer a more stable, interpretable, and ultimately more reliable foundation for understanding asset pricing. They connect the dots between how real companies make decisions in the real economy and how their shares subsequently trade on the market.
That's a fantastic foundational point to end on. It truly makes you think about how we should approach these complex financial puzzles, always seeking that deeper why. Thank you for guiding us so masterfully through this rich material.
My pleasure. It's fascinating work.
And thank you for joining us on this deep dive. And before you go, this deep dive raises an important question for you to perhaps ponder. If fundamental economic theories, like the investment CAPM, rooted in firm behavior and rational decision-making, can explain so much what drives stock returns and account for many observed market anomalies like value, investment, and even parts of momentum, what does that truly imply for the role of pure behavioral biases in the market? And perhaps more provocatively, for how long can those behavioral patterns realistically persist if more rational, economically grounded factors ultimately dominate the pricing landscape? It's a thought that truly challenges how we view market efficiency and the interplay between rational and behavioral finance. Something to chew on.